And then what's the actual cost? So for example, in the next chapter, we're going to talk about balancing high cost items with low cost items. In the restaurant business, you do that already, right? I remember when I worked for Hyatt, we would sell, this is, anyway, giving away my age, we'd sell a filet mignon for $19, okay? And we'd run about a 40% cost because we knew or felt like every person that had a filet mignon would get a cup of coffee. And we charged $3 for a cup of coffee that cost us about a nickel. So our total sales were going to be like $22, and we could weigh that against the cost. So you have a high cost item like a filet and a low cost item like coffee, and you put the two of them together. Same thing happens here. Hot dogs, high cost. Nachos, high cost. Pizza, high cost. What do we hope to sell with each one of those? A drink. What is the cost on a drink? 11%. So that brings our cost back down. You can see we get somewhere around 21%. That's the theory. All right. So now we want to talk about labor. We're going to get into labor expenses. So this is step number 4. And in labor, you've got a number of different types of categories. So you have management. Is management typically fixed or variable in cost?
Fixed.
Why is it fixed?
Because they're on salary.
They're on a salary. What happens?
They get paid the same. all the
That's
time.
right. So if in our this case scenario, if we did $25 million as opposed to $20 million, how much would the manager get paid?
Same amount.
Same thing. If we did $19 million as opposed to 20, how much would the manager get paid? Same thing. So it's a fixed cost. So if you look at Form C on the top, in column number 1, we're listing the different types of management jobs. And if we go to the staffing patterns on page 94, we can see that a general manager works 52 weeks. So we're going to put that right here, 52 weeks a year. And what do we pay a manager per week? $1,600. And how many GMs do we need? One. So what we're going to do is we're going to figure out what the annual salary is. We're going to take one GM times $1,600 a week times 52 weeks, and what does that tell us?
His annual cost.
The annual salary is what? $83,200. Okay? Let's do assistant managers. We got one assistant manager. That assistant manager is going to work 52 weeks out of the year. And we're going to pay that manager how much?
Is that the same thing as a stand manager?
Yeah, okay. So here's what you want to do. That's good. On your sheet here, much like tobacco, it says district manager. If you wanted, you could scratch out district manager and put GM. Where it says stand manager, you could scratch that out and put assistant manager. Warehouse manager, office manager, others, it says list. So all I'm doing here is giving you a sample of what it might be, but you're on the exam, you're going to write in whatever it is. Okay? So in this scenario, case history A in the book, we have a general manager, one assistant manager that makes $1,250 a week. So we take 1 times weekly wage times the number of weeks equals how much? $65,000? Even?
Yes.
Okay, good. Thank you, Sharon. All right, what else do we have? We got an office manager. We have one of those, right? And the office manager makes $800 a week. And they work 52 weeks. What does that equal?
41,600.
41,600? And then what else do we have? We have a warehouse manager, makes $1,000 per week. We only have one of them, 52 weeks. And I'll bet that's $52,000. What's our fixed cost for management for the year? Everybody with me? To find the fixed cost, you're gonna add 83,200 plus 65,000 plus 52,000 plus 41,000.
241,800.
241,800. Everybody agree? All right, that's a fixed cost. Is that good or bad?
I mean,
It's okay.
it's not,
I got an okay.
it depends on
What's our
the
budget?
business. I mean, what kind of money are they to bring in?
It depends on the company standards. So what are our standards? So let's figure out what that is as a cost. So we're gonna take, first of all, I forgot to say this and I should have. Upper right-hand corner, you have to put your total sales. 20 million. Now we're gonna take this number, Kevin, and we're gonna divide it by 20,387,50. I'm guessing it's gonna be somewhere around 1%. Yes, ma'am.
The 241,000, you said that's the fix?
That's fixed cost. It doesn't matter if we do 19 million or 25 million, this is what we're paying the managers every
So
week.
it's the fixed total cost?
Fixed total cost. So what is that as a percentage?
1%.
1% even?
Yeah.
Yeah.
Okay. So the question then is that good or bad? Marley almost answered it. She said, well, it depends. And then I said it depends on the company standard. So if we allow for 2% management, this would be pretty good, right?
Yeah.
Probably would allow us to pay the manager a little bit more money than we do at Ole Miss, for example. Might have an extra assistant GM, maybe a couple other warehouse managers. So we actually have some room here. Now, the column on the far right says PR. PR is payroll-related cost. So if you read the book in the chapters, most of the stuff that I've talked about is in paragraph form here. All right? But payroll-related costs are those expenses that the company pays for that the employee never sees. What would that be? What are some of those expenses? They're mandated expenses like FICA, federal income tax, unemployment insurance, state disability, workers' compensation insurance. Could include benefits, like a contribution to your health insurance, a contribution to your 401k. So payroll-related costs are those costs that are attributed to the employee working there, typically based on some percentage of whatever their income is. And most people don't understand that. So if you're paying an employee $10 an hour, guess what? There's probably another $1.80 that the company is paying on top of that $10 per hour for these other costs that are mandated by the federal government. So you might have Social Security taxes. That makes sense? Did you ever think about that? So if you're working someplace and you're making $10 an hour, the boss is really probably paying about $12 an hour for you to be there, out of his pocket. You're only getting 10, but he's paying 12. The reason I put that in there is because when you go into a budgeting process, too many young managers forget that expense, and they leave it out, and at the end of the year, their profitability is about $200,000 short of what their budget is because they didn't account for payroll-related cost. So if we read this, it says, if we go down staffing patterns V down to E, it says payroll-related costs are typically 14% of total payroll. So what we would do here, what is total payroll? If I had PR PR cost over here at 14%. What is 14% of this number? What's 14% of 241,800?
$14% of $241,000.
$33,852.
Okay, so, pardon me, because my hearing is not good. I heard you say 30,
$33,852.
852. This expense has to be added to this number for total labor cost. Because this is what the total company is going to have to pay. So we're going to take 2, 5, 6, 5, 7, 2. So it's actually going to cost us $275,000 for this management team to work at this stadium. Make sense? Got it? Okay. Let's go to the next section, which is going to be support personnel.
Real quick, can I have to go back, sorry.
Uh-huh.
The 14%, you multiply that, you find 14% of the total fixed cost? Is that what you're
Yes,
saying?
that's exactly right. What we could do is we could take 14% of that number and put it here, and 14% of that number, put it here, 14% of that number, put it here, and add it all up, and it'll be the same number.
No, we
But if
don't
it's
do
all
that.
the same,
If that's just.
why not just multiply times
Oh, it
total?
was just an example, the 14%?
Yeah.
Oh,
So that, on the exam, it'll be given to you.
okay.
In many cases, management makes more than hourly because there are going to be other kind of benefits like 401k and health insurance and things that salaried employees get that typically hourly employees don't. So it may be 18 for management and 14 for hourly employees.
So that final number, the 14% multiplied by the total fixed cost is the payroll percentage?
Yes, this is
The total
payroll-related
payroll
cost. PR. Payroll-related cost is 33,000. So we're going to take the total
Mhm.
plus the payroll-related cost, and it's going to tell us what our total cost is for management.
Okay.
So the managers, okay, are going to get this on their paychecks. The company has to pay out this much to the employees for their benefits and stuff. That make sense?
Yes, thank you.
And this is where everybody makes mistakes because they say, okay, well, this is what I'm paying all my managers, so my total cost is right here. Well, already they're going to be $33,000 off on their budget. Underestimated. Now, if you turn a page in the book, I like the book better than the form. The form gets a little confusing and it's small. In the form, we're going to drop down to the next category, the next box, where it says support personnel. Okay? If you turn the page, it's on page 104. So it's a little bit bigger, it's easier to see. And I think the math is actually easier also in the book. The form is a little bit, you're going to see it's a little confusing. All right, support personnel. Well, guess what? We got all kinds of people working in this stadium, right? And we've got a commissary office where people are making nacho cheese, they're making chili for us, they're prepping pretzels, they're doing a lot of the basic foundation work before the stadium opens. They're not associated with one department or one particular concession stand. So we call those people support personnel. They might even work in the warehouse and make an hourly wage, but they drive their little golf carts around and deliver the product to all the stadium stands. Okay? So, support personnel, we're going to pay them what percent? It doesn't say in the book, but I'm telling you 2%. So we're going to pay 2% of the total expenses. So what's that number? What's 2% of 20 million? 407,000 something? 47.
40,775.
Is it? So I'm trying to read the board over there. I can see it. Is it 407,750?
Yes.
we're gonna pay $407,750 for people to work kind of back of the house, much like you have in a kitchen in a restaurant. You got a garde manger, you got people washing dishes, you got people in the back of the house, and you have to pay them. And their sales are not related to individual categories, but to the overall number. Okay? Then you're gonna have concession personnel. And there are different types of concession personnel. So sometimes we have stand workers. Sometimes we have vendors. And vendors are hawkers. Vendors are the people that walk through the stadium with trays of beer or Coke or cotton candy selling it. They're not associated with one stand. Now, vendors are typically paid a commission. They're paid based on what their sales are. So if I sell, $1,000 worth of something and I get 10%, I get $100. If I sell $100 worth of stuff, I get $10. Makes sense? So the incentive is to get out there and keep selling. However, concession workers typically make an hourly wage. Now the reason this is important is because in the scenario, it should tell us what percent of sales come from concessions and what comes from vendors. So again, back on page 94, Roman numeral 5, C, says concession workers. Concession sales are 75% of total sales. So what we're going to do is we're going to take 75%, 0.75, times the total sales. What are the total sales? 20,387,500. Can you do that for me? 75% of 20,387,500.
15,290,625.
15,290,000. What are the last three digits?
625.
615? That's the sales. And we're going to pay them 10% of their sales. We're going to budget 10%. So we're going to multiply this times 10%. So I think in the book it highlights that pretty well.
Okay, so on our page, so we would do, because we don't have like stand worker vendors, so 0.75 times 20 million, that's just the total sales period for the concession.
For that category of work, that channel. Okay?
Okay.
So concessions is going to be $15 million of the 20 million. Does that make sense? So you're on that page right there. What I want you to do is go to the book, page 104. It's much clearer. It says support personnel, and then it says Roman numeral 3, concession personnel, G. G would be 75% of the total, which is 20 million, which equals 15,290,615. And we're going to multiply that times our budgeted, what we think we're going to spend in labor, which I said is 10%. So multiply that times 10%. The problem with this sheet right here, folks, is it's missing a column.
Yeah, it is.
That's right. See, so you got this correct, you got that correct. Now you have to multiply that times 10%. No, that's right. And that equals something. So where sales is, you put your 15 million.
Okay, so 20,000 times 0.75.
Right. So
So-
15,290,625. I'll put 615.
So then.
That's what the sales, that's what these stand workers are going to generate for us. They're going to make this much money for us doing what they do in the concession stands. And we're going to budget 10% for labor cost. So we're going to take 10% times 15,290. And that's going to equal 1,529,062. This is the cost of labor for concession employees or hourly workers. Now, let's look at, the next piece is that the vendors are gonna earn 25% of the revenue. So what's 25% of 20,387,000? Who's got the calculator?
5,096,875.
96,875?
Yes, sir.
We should be able to add these two together, and it should equal 20 million, and it kind of looks like it does. Yes. Good. Now, we can either pay vendors on a commission of 10%, or we can pay them hourly. So since you're my management team and I need some advice, what do you want to do? Do you want to pay them on commission? Or do you want to pay them on hourly?
I feel like personally, if I was a manager, I would want to pay them hourly because you don't know how much they're gonna sell.
Well,
So,
on commission, they would be driven to sell, try and sell more. Because they're
You're
really working for
incentivized, so
their
the
money.
people that work the hardest make the most.
Yeah.
So it's open discussion. Jessica, which one would you do?
I think I would go with commission.
Commission. Rachel?
Commission.
Ariel?
Commission.
Marley?
Commission.
Oh.
Sure,
You're
we'll
too
go with
easy to
commission.
convince. Okay, so I'm gonna give you one more aspect, okay? Here's a key component you have to remember in this channel of business. Vendors, if you pay them as commissions, they're third-party employees, like contract employees. So therefore, you don't have to pay them the 14% benefits. So you remember when we had management a minute ago and it was 33,000? If you pay commissions, you don't have to pay those benefits, the payroll-related expenses. So not only are you incentivizing the employees, but you're saving 14% in labor. Now, here's the other piece. Marley, I wish you'd have argued just a little bit more, okay? Because there are two sides to every story. So here's what
Well,
happens,
then I'll argue, I'll go hourly.
okay? And so why are you going hourly?
Well, I just personally feel like if I'm a manager, I don't know, I just feel like I would want to be, like if I was having to sell stuff,
So do you
like what
remember?
if you're not a good salesperson?
Right.
Like, because honestly, sometimes sales doesn't come naturally to everybody. Like, me personally, I couldn't sell you anything. I mean, I can at a restaurant.
You've already sold me. You have a great attitude.
Well, I just feel
I'm
like
Team Marley already, and it's only 4 weeks.
I just feel like if I would want to put myself in that person's shoes, and I would hate if my sales skills weren't as good as the next person.
Yeah.
I feel like I would think of that person, you know, with a more compassionate standpoint and be like, okay, they need to be making a fixed amount because, you know, like,
Yeah.
but I don't know, that's just me.
So here's what I have to do. I have to think in terms of being a manager, okay? If I pay hourly, I'm assured that people are gonna come because they know they're gonna make money. So the University of Memphis, right? I need to have people walking through the stands. The University of Memphis played, who'd they play the first game of the year? Then they had the hurricane, remember? And nobody showed up, but I still have to have vendors. Well, everybody that's a vendor is gonna say, well, it's raining and I'm not walking through the stands and I'm not gonna make any money, so I don't come. What do I do now as a manager of the stadium? But if I'm paying hourly, they're gonna come, because they're gonna get paid whether they sell 10 trays or 2 trays.
And then, of course, at the same time, offer incentives to sell.
Exactly. So maybe you could combine that and say, if you sell 10 trays, I'll give you an extra $50. Does that make sense? So you could
So that
combine.
way it's the best of both worlds.
But what's the advantage of paying them commissions versus hourly?
Commission is less.
Why is it
for
less?
you as a manager, because it depends on the customers.
Right. So in other words, you don't have to pay the payroll-related cost on that page that's at 14%. Okay.
So technically, from a business standpoint, I mean, you can see why they pay commission,
That's exactly right.
but me being.
So for example, at the Liberty Bowl Stadium, they use a lot of almost all the volunteer groups. They use volunteer groups because they're third party. They pay them a direct percentage, 10% of whatever your concession sales are. Because they only work 6 or 7 days out of the year. Do you want a job where you only work 6 or 7 days out of the year?
Depends on how much they pay you for those days.
Yeah. If they
Yeah,
paid you
that's true.
$70,000 a day, you'd do it.
Yeah, tight.
Yeah.
Hell yeah.
But if they pay you $10 an hour for 8 hours, you gotta find something that can sustain your way of life, right? Okay. All right, so we figured out these two numbers. Let's say that we're gonna pay these people 8%. Because they're gonna get tips walking through the stadium, much like a bartender gets tips. What's the cost? What's 5,096,000 times 8%?
$407,000,
407,
$750.
750. What's our total hourly cost for employees working the stands? Hopefully it's 1,936,812. How do we figure that as a percentage to total sales? Divided by 20,387,500. What is that number?
This sheet's really tripping me up.
Yes.
Like,
Yeah.
I need to.
That's why you need the book. If you have the book, it's much easier.
What are we trying to do?
We figured that 10%, so here's what we're figuring out. We have these concession stand workers, right? And we're gonna try to figure out how much money are we gonna spend on labor. Remember the 5 M's? Now we're on manpower. How many people can I hire to still make a profit, okay, and do the job right? And so the idea is that I'm gonna budget 10%, okay? I figured out that $20 million, the concession stand workers are going to develop 75% of that $25 million, excuse me, $20 million, which equals $15,290,000. So this is what concession stand workers are going to make in revenue. Now I'm going to budget 10%. I'm willing to give the workers 10%. So 10% of that number is going to be $1,529,062 for the year. That's what it's going to cost me. For the vendors, they typically generate 25% of the revenue, or $5 million of the 20, $1,387,000. And I'm going to pay them 8% because I know they get tips when they walk through the stadium. So I'm going to end up having to outlay or pay out $407,750 for these guys to work. So if I ask you what was the total hourly cost, you would add this plus this equals that, which is $1,936,000. Now, if I wanted to know what that was as a percentage, I would divide it by the total. So what is 1,936,812 divided by the total? 9%. Is it 9 exactly?
9.49.
That's what I need, 9.49%. The reason I've gone through this with you is because on the exam, there's going to be a question. What is the percentage cost of labor for employees or management? So now you know how to do it. Now, is that a good number or a bad number? What did you say?
It's a good number.
It's a good number. Is that a good number or a bad number?
Well, it's only 10%.
Well, if it's 10%, then that's pretty good.
How do you know 10%?
Could you say that?
Yeah, you told us.
Yeah, we kind of went 10% here. What the answer is, it depends on the standard.
Well, okay.
So if the standard is 10%, it's a good number. If the standard is 9%, it's not so good. Right? But we might make allowances because it's a $20 million account, not a $10 million account. So remember, you have to set the standard. We'll do that. We're going to talk about that a whole lot in the next 2 chapters. What's the standard? You have to establish the standard, and then you can figure this out. So let's go back. We're almost finished. We've got 5 minutes. I want to see if this is going to work out. When we come back, we're going to I want you to study this over the next week, okay? Because when we pick back up next week, we're going to finish this chapter, and we're going to go back to labor. Okay. We got, how many seats in this stadium? You remember?
Yeah.
It was in like number 2 in the page 93, Roman numeral number 2, facility, 60,000. All right. How many points of sale do we need for 60,000 people? We need 1 point of sale for every 175 people. So let's divide this out. 60,000 divided by 175. What does that equal?
342.85 or 86, yeah.
I'm going to say 943 because you round up on points of sale. How many employees do I need?
No,
No?
it's 342,
340, okay, 343.
342.
Is that rounded up?
No. Then it would be-
343, yes, you're
yeah.
right, sorry.
343 points of sale. Okay, how many employees do I need?
One per POS.
Times 1.5, and what's that number here?
514.5. So
Five.
515.
15. I need 515 employees. Okay? We're going to pay these employees, let's just say we're going to pay, the average is $8 per person.
It's $4,120.
How much?
$4,120.
4,000, is that right?
Yes.
Okay. 4,000 something 20,
120.
120. Okay, this is per hour, right? For the entire stadium. The average employee works 6 hours.
24,720.
This is per event. Okay? Now, in some cases, we looked back over there and we said the stadium would have 35,000, it would have 50,000, it would have 60,000. So right now, this is what we're going to do. How many events do we have in a year? Do you remember?
40.
40. Multiply this number times 40.
988. 800.
900?
988, 800.
Yeah.
988, 800. Okay. Why did we just do this practice?
To show how quickly money adds up with labor.
Kind of, but not really. What we want to do is we want to do a checks and balances. What we see here, okay, is we're budgeting $1,936,800 for the year, right? What we just did here is we tried to figure out if we did everything according to these standards, how much money would we spend? How much money do we spend?
$988,800.
So which one is higher? This is almost double that. So that should tell us that our budget is fair. In other words, if this came out to be, say, $3 million, then we'd say, okay, programming at 10% is not enough. Because we know we need to have 515 employees per event. That make sense? Times 40 events. That tells me that I'm, right now, if I adopt this standard, and I adopt this standard, and I adopt this standard, and I have this number of events, my cost is going to be just under $1 million in labor for hourly employees.
So on the test, will it just be like a blank chart and you will just be asking like?
On the test, it's going to be just like this piece of paper. Okay, except I think it's modified so it looks more like the book.
And then it's blank and we just have to fill it all out?
You're going to fill it all out. That's exactly right. All the information that I've given you, you see case history A? It's all going to be in case history A. You're going to have to be able to read that and then go back and figure out how to put it in the formats, and then the test will go back and say, can you go to the right form and can you pull the right information?
Okay.
Okay? Happy Valentine's Day.
Thank you.